Boy, old Jerome Powell's press conference today was not the sleeper that I've come to expect. It wasn't that he said anything that surprised me. It was more how he said it. I think that even the CNBC folks were rather enthralled with what he was saying. But then again, I guess they're not a very good measure since they lap up whatever garbage he feeds them. You have Leisman there, who is the professional fed lapdog, always just dumping praise over whatever dump Jerome Powell takes on his desk. The word I would use to describe Powell's press conference today was defiant. I think that he was trying to project strength. I think he was trying to assert control over the situation. And to me, what that signals is that he is rattled. Yes, the usual statement that Powell read was vanilla and boring, as we would expect. The Fed likes to keep things vanilla and boring so that they don't make too many waves. Powell and his underlings understand that his every word can influence the flow of billions of dollars in the various securities markets in the U.S. and around the world. But once he got to the Q&A portion of the press conference after he read his prepared statement, he seemed to be really ad-libbing and speaking off the top of his head, speaking off the cuff, and I think that was a part of a coordinated strategy. I think that he was trying to seem not so stiff and stilted and weak. I think he was trying to seem confident and strong. I'm unsure how successful he was in this endeavor, but the fact that he would change tactics so radically and try this new I guess strongman tough guy sort of approach, and again, not a tough guy by normal person standards, but a tough guy by Fed chairman standards, or at least by Powell standards. He sounded unlike any Fed chairman has sounded, at least since, I guess, the Greenspan days, when Greenspan really could get up there because he was, much smarter than all the people who he was talking to. He could get up there and, really say, he could spout some truth bombs or some lies, and people would buy into them because, he was a very authoritative figure, and he still is, in my view. And so perhaps Powell was trying to pull a bit from the Greenspan playbook. I think that he was trying to assert that kind of authority. And this is all, sort of on a social psychology kind of basis. I'm not really basing this on the actual content of his words. Again, just how he said them, the way he was speaking today. And I think that the way that Powell speaks is almost more important than what he actually speaks. Now, the updated guidance from the Fed today, what essentially it said is that the Fed expects there to be high growth in the U.S. economy, like over 6% this year, as the economy reopens in all 50 states, not just in the free states like Florida and Texas and whatnot. The Fed expects there to be high growth. They also expect there to be inflation over 2%, yet they do not expect that they're going to be raising rates anytime soon. The dot plot, which is a set of dots where different members of the committee think that interest rates will be in the future, the median dot did not move. And what that means is that the Fed is no more interested in hiking rates now than they were at the last meeting. and that's despite a much brighter economic outlook. And it's funny, the folks at CNBC are totally shocked by this. They said, "Oh my gosh, but the Fed is, achieving its goal. We're going to have, high growth and high inflation, on a relative basis, inflation over 2%, and yet the Fed is going to continue with their easy money policy. This is unprecedented." They're shocked. They think that all of a sudden, because the Fed says that the goal of their easy money policy was to create, high growth and inflation at 2%, that if they achieve that goal, that all of a sudden the Fed's going to tighten. The Fed would never tighten at that point, because they know if they tighten even a little teensy-weensy bit, they're going to blow up the entire system. And so Powell had to come out and be a super dove. He had to come out and make it absolutely clear that, by golly, I'm never going to let those rates go up. I'm going to hold them down with my bare hands. I'm going to choke those rates to death and keep them all the way down at zero until time immemorial. Actually, that's a bad choice of phrase, because I believe time immemorial can only refer to things in the far-off past, not the far-off future. But leaving that aside, to me, I'm reading this as Powell getting desperate. Their big weapon that they had here to unleash, to try and try and be dovish, is just to not change their position. They're saying, gosh darn it, we're going to really get tough now, and we're going to make sure interest rates don't go up. So we're going to do the exact same thing that we've been doing the whole time. And I guess that Powell was hoping that if he says that loudly enough and strongly enough, that all of a sudden the bond market is going to bend to his whim. He's trying to aggressively jawbone the bond market back down. He's trying to crush yields. Because supposedly, CNBC tells us that the reason why the bond market, why yields are rising in the Treasury market, is because the bond traders are pricing in a Fed rate hike. Because the bond traders think that Powell's going to hike rates at some point in the next few years. Like by 0.25%. That's what we're being told. That's the reason why bond yields are rising now. And I think that that's totally bunk, because one, Fed's not going to raise rates, as Powell said today. We don't care if we're getting economic growth and and we're meeting our inflation target. Not raising rates, not even by 0.25% ever. We're not going to go from 0% to 0.25%. That's way too hawkish. That's not what this Fed is about. And it's obvious. The bond traders know that. I'm sure that because the bond traders tend to be a much smarter class of people than your stock traders. And so the reason why bond yields are rising, I maintain, is because people are expecting higher rates of inflation. And when inflation rises, that pushes up the inflation premium, which is built into the rate of interest, in any debt instrument. And so I don't see how Powell's speech today is going to, or his Q&A, is going to keep yields in the bond market from rising. He said he's not worried about inflation. He said we're going to let inflation run hot. Although he maintained that it's transitory, which when you're saying inflation is transitory, that's code language for the bond market saying, hey, you shouldn't price inflation into long-term bond yields. There's not going to be long-term inflation. You don't have to worry about that. Over the course of 10 years, the inflation's going to average out to 2%. There's absolutely no inflation premium rise that should be priced into the bonds. And so what's Powell's justification for this? He says, well, it's because we're having bottlenecks in production, and it's hard to ship things in and out. And actually, it's what I was talking about yesterday. I was glad to hear Powell address this issue. When I was talking about the example of the shippers not being able to conduct international trade because not enough goods are leaving the U.S., and so you have all these empty shipping containers building up in the U.S. that are not being filled with goods to send back, across the rest of the world. And so, we're just having all this net inflow of goods coming in from Asia, and then all these ships are stuck here, and they need goods to take somewhere else so that they, can afford to run, because it costs a lot of money. If you're just driving around an empty, cargo ship, that costs a lot of money. And so these freighters can't afford to do that. And that's creating a serious bottleneck, because it's hard to get stuff into the U.S. now because there's fewer and fewer ships going back and forth. There's so many ships and shipping containers that are just parked here in the U.S. And so Powell says this is why we're seeing inflation. It's because of this. And these bottlenecks will clear up. He says that producers, they don't want to raise prices on their customers, even if, in the short term, producers, they're going to have higher costs because it's hard to get stuff in and out of the U.S. And so they're having trouble getting supplies. But they're not going to pass that on to their consumers. They don't want to do that because they know that it's transitory. And they don't want to, make their customers suffer by having to pay higher prices for goods. And so Powell says once these bottlenecks clear up, well, then everything will be fine. And prices will return to where they are. So inflation is transitory. Now, that was as deep as his explanation went. And so, to me, it's pretty easy to knock that down. Now, maybe he has a more sophisticated reason behind, that he's saying that. But just based on what he said, that's not a sure thing by any means, that the bottlenecks will just clear up, because he didn't address why there's a bottleneck to begin with. The reason why there's a bottleneck to begin with, which I talked about yesterday, if you go back and watch that video and listen to what I said there, I was talking about the reason why we have all this bottleneck in shipping of imports into the U.S. is because the American economy is largely shut down. We're not exporting anything. But we've got lots of cash here that we're able to spend on imports, so we're able to keep consuming goods without producing much of anything ourselves, which, the U.S. has been largely doing that for the last 40 years, which is why we've run a trade deficit year after year, but the trade deficits are more extreme now than they've ever been. And so the reason why these huge bottlenecks exist is because we're importing so much. We're consuming so much more than we produce. And when you do that, you're going to get inflation because we're paying for all that by just printing new money. We're not creating stuff to pay for all these goods. And that's why, that's ultimately why there's inflation. This is an example of the Fed's easy money policy inflating prices in the real economy, and Jerome Powell just doesn't want to admit it. He wants to blame it on this vague notion of bottlenecks, which he thinks he plays no role in. But if Jerome Powell doing what he's been doing this whole time has led us to this point, well then if Jerome Powell doesn't change anything and he's going to keep doing the exact same thing, why would he think that this bottleneck would disappear? Why is it that he thinks that inflation will just be transitory when the inflation is a direct result of his actions? It seems clear to me that Powell's tough talk today was a bluff. He's bluffing, trying to act like he has control, but what he's really doing is he's lashing out. And you could tell he was visibly frustrated with the usual softball questions that the financial media throws at him. And even that was angering him. He did not like to be asked about the dot plot, and he was very angry that he had to answer questions about the dot plot. And he said, hey, don't pay attention to the dot plot. Doesn't mean anything. You should stop paying. Why are you asking me questions about that? I mean, he was just very nasty about it, again, by Fed chairman standards. Fed chairmen are supposed to be very polite people. Financial media and all this is supposed to be a very, very buttoned up sector of our society. And I mean, his conduct was really unprecedented in his tenure as Fed chair. And CNBC couldn't wait to apologize for him on his behalf and explain why, he was justified doing that and treating people that way as soon as they came back on. And, they had a guest who was talking about how, maybe we should get rid of this dot plot thing because, the Fed chair shouldn't have to answer questions about this. This is just, this is ridiculous. We need to reform the dot plot so that people don't ask questions about it. It should just be something so meaningless that nobody cares about it. Because the fact that the dot plot, is seen as significant by, a couple of journalists to where they feel like they should ask questions about it, well, then the dot plot is too much of a distraction. We have to get rid of it. And the reason for this is that the dot plot slightly undermined the Fed's narrative, and really not by much. I mean, all it showed was that a couple of people on the committee thought that rates are going to be higher in 2023, long way off. They thought that rates might go up. That's all that the dot plot said. And, you know, the journalists were asking, well, I mean, doesn't this show division in the ranks? You have a couple of people there who think that the interest rates are going to rise. I mean, doesn't that show that maybe the whole committee is moving in that direction, upwards? And, you know, Powell was like, no, you know, we're a 0% committee. That's what we're about. We're total consensus. And so it was clear. The point of today was to jawbone the bond market and interest rates in the entire economy to the downside, to make it absolutely clear, no, the Fed's not going to let this happen. Well, what Powell doesn't want to admit is that it's not his choice at this point. Rates are going up whether he says that he wants them higher or not. I think that what we saw today was Powell starting to sense that he's losing his grip on power, that he no longer can dictate what the rate of interest should be in our market economy, our nominally market economy. Because of course, in a real actual market, and I wouldn't even say free market, it doesn't have to be totally free, but I mean, to have any semblance of a market economy, the most important price in that economy must be determined by market forces, not by a Politburo. You know, if you have a Politburo determining your interest rates, you're pretty much 75% of the way towards a centrally planned economy. Because by controlling the rate of interest, you can pretty much manipulate the structure of production, the entire, makeup of the U.S. economy, with a great level of precision, relatively speaking, for one panel of a few people. And by having some, nominal market forces on the low end, small businesses, things like that, the Fed is able to delegate some of the finer details that they might not necessarily be specialized enough to understand, which is where the Soviet Politburos went wrong. But generally speaking, the Fed can control the direction of the U.S. economy. But if they cannot control the rate of interest, if Powell says interest rates will be low, and yet rates rise despite his words, then he's totally powerless. Then at that point, the Fed's authority breaks down. His words start to ring hollow. And at that stage, capitalism will begin to reassert itself. And so, again, I will hold out and see if maybe the Fed has something else up there, some other tricks up their sleeve. Again, people keep throwing yield curve control out like it's some kind of magic button that Powell can press to make sure that rates don't rise. But from what I understand, that's not working out so well in Australia. So if it's not working for them, and Powell, if he comes in late after he's already losing control of the credit markets and tries to institute yield curve control in a more overt sense than he's already doing it, well, it might be too late by that point. I think that we're starting to see Powell lose his grip, and hopefully he loses control completely. Interest rates, the 10-year, I was looking, I think it closed at like 1.64 and a half. We're well above 1.5, and we're on our way to 2%. And a 10-year yield at 2% is not something that that the markets in the U.S. in general, really any market, is going to be happy with. That's something that is going to cause a lot of chaos again, like back in 2018. Of course, back in 2018, it was the Fed hiking rates that ultimately led to that drawdown, which was totally predictable. It's obvious because, when you're in a bubble created by low interest rates set by the Fed, if the Fed starts raising interest rates, the air is going to come out of that bubble pretty quickly, and that's what was happening. Powell stepped in and he said, not on my watch. Never mind. Oops. We're going back to 0%. But now the Fed has no ammunition to cut rates. there's not much left that they can do. So if rates start to rise on their own, and then followed by what we're going to see is a repeat of 2018, but the Fed is not going to be able to do anything to put a floor in the market. And then perhaps the final collapse will be able to finally begin in earnest.